Most amateur traders are caught in a brutal, predictable loop. They watch a string of green candles, buy at the peak out of fear, and watch the market turn. When fear flips to panic, they sell their positions right at the bottom. Often, the moment they hit the sell button to cut their losses, price stops dropping and reverses. They lock in a loss while the rally resumes without them. The difficulty lies in the execution. In a volatile market, looking at a plunging chart rarely reveals whether you are just seeing a temporary discount or a complete structural breakdown. Experienced professionals ignore gut feelings and wait for a specific mathematical overlap. They look for the point where retail panic reaches its extreme and institutional capital begins to absorb the forced selling. Surviving these markets requires abandoning emotional reactions for a two-lens framework, one that tracks institutional positioning and another that measures the exhaustion of the crowd. The first lens is the exponential moving average, or EMA. Rather than using it to predict the future, professionals use it to define the structural context of the market. It provides a real-time map of where institutional money is currently positioned. This chart shows the ideal configuration, the EMA stack. Using the 9, 21, and 50 period lines in the specific ascending order identifies a healthy, dominant uptrend. The top line tracks short-term momentum. The middle and bottom lines serve as dynamic pullback zones, areas where the broader trend is frequently tested by the market. When price makes a sharp drop into these lower zones, while the stack remains in order, it often signals a reset. The market is clearing out over-leveraged positions and sweeping stop losses before the primary trend continues. Buying a falling price without this underlying EMA structure is functionally gambling against the dominant flow of capital. The second lens, the Relative Strength Index, or RSI, measures the velocity of price movement. It functions as a speedometer for crowd momentum. When this gauge drops below 30, it quantifies peak retail panic. The velocity of the sell-off has reached its extreme, signaling mass capitulation. However, buying simply because the RSI is low is dangerous. In a true downtrend, panic can sustain itself for long periods while the price continues to reach new lows. The professional setup occurs when these two lenses overlap. We look for a price drop into the established EMA pullback zone at the exact same moment the RSI registers extreme panic in the bottom section. The trigger is the momentum line itself. It must stop falling and begin curling upward. This curve is the visual evidence that the selling pressure is finally exhausted. This zoom shows the final safeguard, price action confirmation. This pin bar, with its long lower wick, indicates that smart money has entered the market to absorb the remaining sell orders, creating a sharp projection of lower prices. Aligning structural support with emotional exhaustion changes the nature of the trade. It transforms a chaotic market drop into a high-probability entry point. Perfect setups can still fail. Market makers often drive prices deeper than expected to sweep liquidity from amateur traders before allowing the price to move higher. Professionals defend against these sweeps by placing stop losses below the lowest EMA boundary. This buffer allows the trade to survive temporary volatility spikes that would otherwise trigger a premature exit. Profit logic is equally strict. Targets should reach previous price highs to ensure a minimum 1-to-2 risk-to-reward ratio. This asymmetry ensures that the mathematical outcome remains positive over a series of trades. This framework serves as a behavioral guardrail. It requires the trader to ignore intraday noise and limit execution to the moments where specific mathematical conditions converge. The most consistent opportunities are found by identifying the precise moment where mass market chaos meets structural law.